if you're kicking the can down the road, when do you get to an uphill climb? When do you feel that Kenya isn't too far? Or the government might default, the government might find itself in trouble in repaying its creditors. But many a times people think, oh, that's the boy who cried wolf.
It's difficult betting against Kenya. Kenya has been through a lot. If you look back at even more than a decade ago, we had the post-election violence. We came out of it. So things that look like movie episodes. We've been able to come from them, but recently, I'm also one of the people who believe that Kenya can't default, Kenya won't default, but we're not looking at if, we're looking at when. That's the conversation or the discussion that we are having. But all this will entirely depend on the government and how it solves and how it tackles all this. For example, commercial loans.
Kenya's domestic debt as of August 23, 2024 stood at around 5.5 trillion shillings. Now, 13.5% of these, or just under 800 billion shillings, is held by non-institutional investors. And so that means you and me. And so, even as we all get into the business of buying government bonds, treasury bills, and bonds, we've seen risks emanating from these. And people have been asking the question, what if the government defaults? What if we are all in too deep into the rabbit hole and we left holding nothing if the government is unable to settle such the same responsibilities? And today, we'll have a conversation on this, and I'm glad to be joined by Stellar Swakei. Stellar Swakei is a senior research associate at the Standard Investment Bank. So Stella, thank you and welcome to the podcast.
Thanks, Kevin.
And thanks to have you as we make a return for the podcast. So this is our third season. And I'd like to pick it up from where we left. We've never seen the government defaulting on any of its debt, domestic or external, but we've seen the risk that can be there. And I think what we've seen is rating agencies, showing that risk of default. We've seen Moody's, we've seen S&P Global doing the same. And at the same time, domestically, we've been seeing the government missing some of its payments, be it pension payments. We've seen what has happened with the teachers. As CBA is not being honored, we are having conversations around, do they strike? Do they wait it out? There's a court process, of course, to solve that. And so we've seen the government missing most of its obligations, but never on debt. But then again, most of us are already in there, be it your 50,000, be it your 100,000 shillings. Somehow we are all tied into it. Some of us might not be directly into bonds, but we are holding money in banks, and banks also investing in the same instruments. At the same time, to take you to the August infrastructure bond auction, the tax-free bond and the interest it attracted, you're talking of times over what the government was even looking for. Even as we talk of the jitters, and you've seen talk in the streets, we've seen the conversations that have been there on social media about, the risk that the government poses. But even with that, like I said, people are still giving our money to government. So do you feel like we are in too deep in a sense? Are we too in deep? Are we in, head over heels? All in, hook, line, and sinker into government bonds?
Well, I feel like it's selective, because when you look at treasury bills, you're looking at the three treasury bills. You have the 91-day paper, we have the 182 and the 364. So for the 182 and 364, there's no much interest as compared to the 91-day paper. That's why I'm saying it's selective. When we come to the bonds, for the fixed deposit bonds, the FXD ones, the interest is not as much as for the IFBs, the infrastructure bonds. Oh. If you remember correctly, the June bonds, fixed deposit bonds, did not perform very well, and then we had a tap sale, and the tap sale only raised 400 and something million, like 7 years ago, almost a decade. So for me, I feel like it's very selective, and IFBs of infrastructure bonds are the ones that we are so excited about. We are not very much considering the fact that it's risky and the government may default at some point. And we've seen so much interest, as you've said, even with the August bond. The government raised 88 billion, and they just wanted 50 billion. And then they went ahead to even issue a tap sale, which is still in the market. So for me, it's selective. The excitement is selective. And given that we have 50% of our debt, approximately 50% of our debt is domestic. So we are looking at around 5 trillion or 5 point something trillion, and 85% of this is in treasury bonds. So maybe we are in it too deep, and if the government defaulted at some point, then it would mess a lot of things in the economy, because it goes down to most everything, totally everything. It goes down to economic growth, it goes down to inflation, it goes down to banks that we consider a face or something that shows how the economy is doing. So it would go down, it would affect everyone, not necessarily those, as you've rightly put it, not necessarily the ones that have holding in bonds or treasury bills. So I'd like to talk about the return we are getting from this. And you mentioned the excitement around infrastructure bond, and of course we know their tax-free nature is what makes them quite the attraction. But we've seen the high yields, especially this year, the high interest rates you're getting from them. I think the February bond, which, for full disclosure, I put something in there, so walking around with that 18.46% return in my pocket. But even as we look at it, should it be an indicator of the risk, in that we always consider government to be the low risk route? But when they're offering the highest return, even more than, you would argue even the stock market, only rare days or rare periods where you could get a return higher than that. No dividend payout, other NSCs bigger than that. We've seen real estate, the rents, you can't push them to a certain point. So somehow we have your lowest risk asset yielding your highest return in an economy, but somehow we just take excitement in it. Wow. That's 18.46%. I think the other one was 18.3 in August. That's the return we got from that infrastructure bond. Do you feel that the returns we are seeing then speak to the risk, and we should not only looking at it as an excitement thing, as something to pocket, because you tend to do that a lot? So again, the risk return trade-off principle has to apply for many asset classes. And considering that Kenya is currently and has been under junk bonds, junk is high yield bonds, I believe that the returns or the rates that we are seeing speak to the risk. Investors are asking for more compensation given the risk that they are willing, or the additional risk that they are taking. And now that you've also mentioned that S&P, Fitch and Moody's, all of them downgraded Kenya. So it's only getting riskier. So I really believe that the higher interest rates reflect the risks that we are encountering. And recently, a lot has been happening in terms of the fiscal space. We have the issue of the withdrawal of the Finance Bill 2024, and then the Finance Act 2023 is still in litigation. So there's too much uncertainty when it comes to the fiscal space of Kenya, and it will only get again riskier as we go ahead, because I do not see any particular not hope, I wouldn't call it hope, but there's no particular, we do not see how these things will be sorted out, especially now, or we just wait for the Supreme Court to make its judgment. Then again, we will start to measure our risks after that, because if it's withdrawn again, if it's nullified, we are looking at very high fiscal deficits, which means that the government will automatically be desperate to borrow money. And you see, when the government is desperate, then rates will continue to increase, because again, it reflects the increasing risks that the government might not be able to meet these obligations when time comes.
And we spoke of the credit ratings, and just for someone wondering, okay, how should I be reading when I hear Kenya has been downgraded? At a personal level, it's more of a CRB listing in a sense. But for government, how should I interpret that? I have my 50, I have my 100,000. I've seen bonds, I've seen the return. It's lucrative. I know there's another FB perhaps coming in March next year. How should I read these ratings and informing my decision into investing? Do I just go all in and be, they've never defaulted, it's 18%, it's 17%, it's whatever percentage it is. Not just pocket it and not be so wary of, what.
Yeah.
Especially we tend to look at it as more Westerner, it's a Westerner feel of what you're doing. Yet someone might be, you've never defaulted, the government always pays its obligations.
Yeah.
What's the risk, really? How should we be interpreting those downgrades?
I actually love that you've called government securities low risk, because many people call them non-risk or no risk, and there's no particular investment that has got no risk. So credit rating for a government, actually it's similar to CRB, just that these agencies are rating the credit worthiness of a whole sovereign, like a whole country. So you cannot particularly say that a government won't default. Probably Ghanaians were saying the same before they defaulted. So an individual investor who is looking at a downgrade of Kenya's credit rating should not plan for long term, because looking at the long term right now, we are more certain of the short term than we are of the long term. So what I mean by this is that an investor shouldn't look at I'll be giving now investment advice, but it's not necessarily disclaimer. You should not consider this as investment advice. So you shouldn't be looking at things long term in your view, what you call long term. For me, long term is 2 years and above. So I wouldn't look at an investment that in government securities above 2 years, because with these downgrades, and probably we will have another rating next year after we've made developments and all that, I wouldn't look at a longer term. That will be my interpretation of the downgrade, because I'm not certain of the future. I don't know what it holds, but I can give an outlook, or I can gauge what will happen in the short term. So I might not lose a lot of money in the short term, and I can take advantage of the high rates that we're experiencing right now. I can pocket that gain, but long term, I wouldn't touch there.
So I think another full disclosure before I go into my next question to you is, I started this business of following the investment space, say, right around 2018. And conversations back then, and shout out to someone you might know, Churchill, or go to an economist. I think then I was just starting out, actually intern level, and this is what we talked about. The government kicking the can down the road so that you have short-term difficulties, but you're able to solve them by borrowing, and that's a payment you'll make 5, 6, 7 years down the line. And so you take care of business. And it's 2024, it's 5, 6 years later from that point. We are still having the same discussion that the Eurobond we saw that we repaid in June, of course we saw the difficulties it would have brought, but we managed to still raise resources, and push out that obligation further out, and bring some breathing room in a sense. So for me is when do you get, if you are kicking the can down the road, when do you get to an uphill climb in a sense? How soon until you get to that uphill climb, and do you feel that Kenya isn't too far? Maybe we always talk of, the government might default, the government might find itself in trouble in repaying its creditors. But many a times people think, that's the boy who cried wolf. Say the wolf is coming, the wolf didn't come. What's your take here? When do we face that difficulty that now we're actually facing it in the eye that the government can't pay you back your money, and we are all in as we looked at it from the statistics?
Well, I share the same concerns, and actually before I came here, we were having a discussion with my colleagues, and one of the things that came out was that it's difficult betting against Kenya, because Kenya has been through a lot. We've had difficult moments. You look back at even more than a decade ago, we had the post-election violence. We came out of it. So things that look like movie episodes, and we've been able to come from them. But recently, I'm also one of the people who believed that Kenya can't default, Kenya won't default. But there has been so much uncertainty nowadays, and I feel like we're not looking at if we're looking at when. That's the conversation or the discussion that we are having. But all these will entirely depend on the government and how it solves and how it tackles all this. So the government can choose to, we keep saying restructure and all that. But you see, we don't even know most of the details on these loans that the government takes. For example, commercial loans. You can't particularly point out and say this loan from China Export-Import Bank is at this rate. This is the interest rate that they borrowed at.
Yeah.
So, the same way they can do a silent restructuring with such people and focus more on concessional loans, which are very cheap, 5% and below or so interest rates. So what I mean is, to answer your question, if this is the time or this is the point that we are looking at, we've gotten there where we are going uphill now, it will largely depend on how the government tackles all these. We keep telling them to cut expenditure, and it seems to be a very difficult thing for the government to do, but I feel like it's entirely upon them on how they choose to tackle this particular issue.
Yeah.
We may not get there, and we may get there, depending on how they do it. And it's particularly difficult for... It's when you say we are kicking the can down the road, it's true, and it's a concern because we are borrowing money to service existing debt, which means that we're not investing in capital expenditure. We're not doing capital expenditure. We're not doing any development or any investments that will give us money and that we will be able to pay back these loans. So it means if you're borrowing a 5-year loan and we will be paying interest for these 5 years, at the end of the 5 years, we'll still have to borrow. So when does the cycle end?
Yeah.
And that's why I'm saying it largely depends on the government, how they choose to tackle this. They can just decide, let's truly cut down expenditure. Because we cannot be financing our expenditure as a country 50% using debt. It's not economical at all. So how the government chooses to go, they're the ones who will take us there.
Yeah.
Yeah.
All right. So before we take a trip to West Africa and talk about Ghana, I've seen people sharing quite the screenshots of the payment from the February infrastructure bond. CBK has processed your payment, it's landing in your account, and people are so excited. Look, guys, I told you, this is an investment, you're getting your payment, the next one comes around February, March again next year.
Yeah.
And that goes on, and that's likely the expectation. You can even start scheduling for, what to expect. What will I do with my 10,000 shillings interest, or much more for that, for those who can put in more, I've seen people screenshotting interest of up to close to 96,000 shillings.
Yeah.
And it's quite exciting when, you expect this payment to come. But when it stops is when the problems start. And with that now we can segue into Ghana and see what happened that's 2022. And I think before they defaulted, we had seen the same rating actions.
Yes.
Just before they defaulted. And we know what happened is, you had to, in a sense, suspend the expectation. Some of those payments were not coming through, even to retail investors, where, there's a pause, and then they set down the interest rates you have to receive in future years.
Yeah.
And looking at Ghana now, would you see a situation where individuals, you and me, suffer the same consequences, or might you see individuals as perhaps being shielded? Perhaps it's our pension funds, our insurance firms. Unfortunately, we are all involved in the banking system, so I wouldn't say we are outside of that, but in case we ever get to a point where the government might not be able to immediately service or have to restructure some of its domestic debt, where do you feel we would sit as individuals?
Well, I feel like we'd go the same way, whereby retailers won't be affected, because as we speak of Ghana, I remember even that month before they announced that they were going to suspend the payments on external debt, they issued what was it called? A debt conversion something, domestic debt.
Yeah.
Yeah, so typically restructuring.
Yeah.
So they restructured the debt, but it was solely or entirely for institutional investors. So the retailers were not really affected. They continued to, they were paid their interest payments and the maturities that were due. were not affected. So I think we'd go the same way, because amounts owed to retailers are not as huge as for institutional investors. So probably that is something that they can do, because you wouldn't want to bring in retailers to your, you know, even the issue of, for example, infrastructure bond. Let me use an example.
Yeah.
For infrastructure bonds, when we talk of amortized bonds, retailers get their money in the first maturity. By amortized, let me just explain for the listeners, not you. Amortized is a maturity that is spread, or redemption dates that are spread across different dates. So for retailers or people who invest less than $1 million or up to $1 million are usually paid all their money at the first maturity.
Yeah.
So when you look at this, the government tries to avoid the issue of small money. It's small money for the government, not for an individual.
True.
Yeah.
Important to say.
So the government tries to avoid the issue of small cash, because it's a lot of work for small money. So even if we get to such a point, I believe that the government wouldn't want to involve retailers, because there are so many of them. Each of them has a small amount of money to the government, but it's big amount of money to them.
To close it off, last but not least, and perhaps even the most important questions, we've talked of the game being treasury bonds or government securities, depending on the name you each one of us can have for them. When you're getting 18%, 17% on government bonds, how do you diversify? Do you need to diversify, or do I just go all in? I've seen stories of people wanting to sell their land to put the money in government bonds, because they say, oh, my land, my farming activities are not returning anything close, so I'll just sell my land, pack it up in a bond, a 10-year bond perhaps, and just have the interest all along. And once I get back my money, I'll decide, do I buy the land again or just reinvest that money? How can you diversify when it's so compelling to just stick around government bonds? Just to close it off as we wrap up.
Yeah, so diversification is very important for an investor, and you can't entirely depend on the return and forego or ignore the risk that you're taking. So for me, I'd really advise people or retail investors to diversify. Land is a very good investment because it's an inflation hedge. It will remain there even after the government defaults. Your land will still be there. No one will haircut you for your land. Yeah. But now the issue with other investment classes, when you look at, for example, an MMF, money market funds entirely invest in fixed income. So they invest in the same bonds, the same treasury bills, and their institutions. When you look at equities, in the case of a default, equities would also feel the brunt, because there will be so much investor outflow, capital outflow. So probably stock prices would dip. So that's you have to trade off really well and do a tough balancing action. But in this case, to avoid or to mitigate this risk, an investor can put their money in funds that do offshore investments. We have the likes of Mansa. We have other funds that do indices. So you see, when you have exposure globally, at least you have something that you're looking at. You'll mitigate your risks. And probably now that some markets have been recovering, we have seen very good rates for equities. So it's a good trade-off. In case this doesn't work out, you'll have some form of income from another investment. So diversification is very key. You cannot ignore that fact.
All right. Thanks. Unfortunately, that's all the time we had for this conversation. We would like to go more into inflation hedging. I've seen people joking about, buying even cattle, as an inflation hedge, if things go bust, have something. And I like what you said about land, land won't go anywhere. So you'll always have that property, whether they term it as valueless or less valuable, you still have that. So thanks so much. That has been Stellar Swakei, Senior Research Associate at Standard Investment Bank. And thank you for gracing our first podcast of the third season. And this has been Make Money the podcast. And I'd like to thank you for tuning into this conversation. We'll have more in this conversation around the investment space as the season carries on. And you can find us now across platforms. We are now audiovisual, if you noticed from the previous episodes. So find us all across the different platforms you consume your podcast at Make Money by The Business Daily. This is a production of The Business Daily. I am Kefa Moirore, and catch you next time.